one of the other planning considerations that we keep in mind, and you both mentioned this to an extent, is that they're going to receive this money at some time in the future, and that will become taxable income. So that's another election that we generally talk through with our clients is how and when do they want to start receiving those deferred compensation payments. So again, as an example, one of the things that we discuss with our clients, if they're in a higher tax state like California, New Jersey, New York, but they may have a goal to retire to a state with lower or no income taxes. So this can create an additional tax benefit later, right? If we make an election to have that deferred compensation paid out over a 10-year time period, right? If we make that election over the 10-year time period and they start receiving that income when they're retired and no longer working, again, theoretically in a lower tax bracket, but also in a tax situation where they won't have to pay income taxes at the state level. And that's very important because that's income that they would otherwise be receiving in that year, where if they're working in New York, as an example, you have New York state tax, potentially New York City tax. So again, it really becomes a very powerful resource for our higher earning corporate executive clients. So that's another consideration that we talk through with our clients in helping them make those deferred compensation elections.